After returning 26% in 2023, the S&P 500 posted another stellar year, up nearly 25% in 2024. The last time the benchmark U.S. index saw back-to-back returns greater than 20% was in 1998. These strong returns were driven by the technology sector, with the NASDAQ index up nearly 30%. International and small-cap stocks underperformed the U.S., and bonds just barely saw a positive return in 2024. Total returns in the S&P 500 were highly concentrated, with the Magnificent Seven companies driving the majority of the performance. These companies include Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. The S&P 500 more heavily weights larger companies, which led to the market cap weighted index returning almost double compared to an equally weighted basket of the same 500 stocks. The rise in the overall stock market has led to an increase in valuations. The forward price-to-earnings ratio of the benchmark U.S. index is approaching the peak levels seen during the dot-com era of the late 1990s. The top 10 stocks in the index are particularly expensive, at nearly 30 times earnings, compared to an average level of 20.6. Inflation has retreated from the post-pandemic spike in 2022, although it seems stuck in neutral at around 2.5% to 3%. The Federal Reserve would like to see further progress in inflation retreating to its 2% target level. Trump's proposals on increased tariffs, continued tax cuts, and immigration restriction could prove inflationary and complicate the Fed's plans. At its December meeting, the Fed penciled in only 2 interest rate cuts this year, compared to the 4 cuts it had predicted at its November meeting. If inflation remains where it is, or if it moves higher, the Fed could be forced to refrain from cutting or even return to interest rate hikes going forward in order to bring inflation down toward its target. After years of extremely low interest rates, the 10-year Treasury has risen to about 4.5%. Longer-term bonds have sold off and yields have risen, alongside stubborn inflation and the possibility that the Fed may have to keep interest rates where they are, or even increase current rates. This would call into question the high equity market valuations and could cause the current equity bull market to stumble.